Hey guys, welcome back to the Trading Coach Podcast. As always, I'm your host, Akil Stokes. In today's episode, we're going to be talking about position sizing strategies and giving you a little bit of information about some that will hopefully help you make the decision whether it's something you want to use or something you want to stay very far away from. Let's hop in. And there's pros and cons to each. We're not going to dig too much into them because, again, this stuff doesn't really matter until after you've done all the other stuff, back testing, strategy development, learning how to trade. But there are pros and cons of each, especially when it comes to implementing a position sizing strategy, which is our next one. Now, there are a few, there's lots, but a few I want to kind of touch on just kind of based on what we spoke about so far this week, different position sizing strategies. Number one, and this is what I would say probably the majority of traders do, but also keep in mind that the majority of traders have no idea what they're doing, is random, right? Is random. Now, have any of you guys ever done this, the random? Don't shame yourself. I have as well. And what I mean by random is like you just see a trade and you put on something. There's no calculations. There's no rhyme or reason. You just, I'm gonna put too many lots on this. Anyone been there? Everyone's shy and ashamed. I have. I'm raising my hand. I had no idea what position sizing tactics or strategies were when I first started trading. I just picked a number that felt good. And I was like, all right, well, cool. Lost it. Dang it. So random's going to be the first one. We probably shouldn't even list it under it because it's not a strategy, but it is something that people do and want to make you guys aware of it. We spoke about this a little bit, and so I want to follow up on this. The martingale strategy and the reverse martingale strategy. And this is something we also see a lot of newer traders do. And this is, in my opinion, so let's put it this way. There is a mathematical reason for doing this, but in my opinion, most people do it for the psychological reason. So basically the martingale approach is this, right? And there's a reverse martingale as well. But as you are losing, your position size gets bigger. Now, why do you think we would want to add to our position size as we're losing? Why would that be? What do you think the idea behind that is? So as I lose, if I trade one mini lot on trade one and I lose, I'm going to trade two on the next one and I lose. I'm going to trade four after that, right? It allows us to make up for the loss, right? If I take two steps back and I want to jump 4 steps forward to kind of get back to break even, to cover for the previous losses. And there's a cool chart I'll show you later about, the drawdown recovery chart, which I think will blow your mind as well. A lot of brain explosions happening today. So make sure to bring your napkin, right? Your handkerchief. Now, what do you think the problem is with this martingale approach? And again, most people do it not because they like the mathematical approach, but rather it's kind of human nature, right? It's Jason's at the roulette table. He loses his money, so he doubles his bet for the next one because it's the quickest way to make it back in his mind. But going back to our coin toss theory, right? Is it actually the quickest way to make it back by risking more on the very next move? In our mind, we think it is. And maybe if it were something that we can control, like if I'm playing you one-on-one in basketball and I know I'm better than you, okay, double or nothing, because I trust myself, I can control it. But in trading, right? We got to remember the law of large numbers. We don't know when the wins are coming. We don't know the outcome of any given trade. I don't know if this current trade is going to win. I don't know if the next trade is going to win. I don't know if 3 trades from now is going to win. I don't know. So why are we increasing our risk, right? Why are we increasing our risk in a situation where we actually have no idea if we're more likely to win or not? All we're doing is putting ourselves at more risk. And then if we lose that next trade, we're just putting ourselves at even more risk. And this is where we snort the hopium, right? we hope that we can eventually get that win that will bring us back to life. And that win will eventually come. The problem is most traders go broke before that win comes. That's the problem. They're waiting and waiting and waiting for that win that will bring them back to life, but it's too late. They've increased their risk so much that they've lost everything before they had a chance for that win to come. They weren't able to weather the storm. And it is actual strategy. It is an actual strategy. It's not one that I'm a fan of, but just kind of to give you an example. So if you know your numbers, right? If when you back test, you know all your numbers. You should know your largest winning streaks. You should know your largest losing streaks. You should know your average winning streaks, your average losing streaks, stuff like that. So for example, if you've got 10 years of back testing data and you see in that 10 years, again, anything can happen. We never know the future, but we use the past to give us the best prediction. If you know that you've never had more than a 4-trade losing streak, when you take 4 trades in a row, you have a fair amount of confidence that that next trade is going to be a win just because of past data. Now, we don't know for sure, so it's still risky, but you have a good idea. So the same way where it's like when I'm on a losing streak, I kind of get this sick like smile. It's weird, like a Joker type smile, because I know my win percentage. And I know that after I get these losses out the way, a string of wins are coming. Now, again, I don't know when they're coming, so I don't do anything crazy with my position sizing, but does that make sense? So it's not just stupidity. Now, a lot of people do it because of stupidity. They just randomly do it, but there is a mathematical equation to it. Like if done smartly, again, not my personal preference, but if done smartly, you can do it in a way that makes sense. But most people, to say that most traders are doing it smartly is most likely not the case. I think we can all agree. So that's the martingale. There's the reverse martingale as well. Kind of this would be the risk averse one where you do the exact opposite. So as you're on a winning streak, you start reducing your position size because you're in fear of that losing streak coming, right? So the first one was as you're losing, you increase your position size to make it back, to attempt to make it back. The reverse is as you're on a winning streak, you start reducing your position size, preparing for the losses. And again, if you know your numbers, let's say I know that I'm a 70% trader. So if I take I'm not a 70% trader, by the way, but just as an example, I know that I'm a 70% trader. If I get 7 wins in a row, what do you think I'm expecting in my mind? I'm probably expecting some losses to come, right? So I'm preparing myself. I'm reducing my position size in order to absorb those losses. Now, what's the problem with that? What do you think the problem with that is? That probably sounds a little bit better. Some of you are like, hey, you know what? Yeah, it comes down to the same situation, right, LJ? Right? Do I know that the loss is coming? I may have a good idea. I may be like, it's probably coming, but do I know? I don't know for sure. And what happens if I reduce my position size and I'm on a heater? I go through a hot streak where I'm winning 10 in a row. Maybe that next trade is my big home run trade. But now I'm not capturing the profit that I'm supposed to because I lowered my position size. And again, in trading, it's a series of extensions and drawdowns, right? Our wins cover for our losses. So we need to maximize our winning streaks and not self-sabotage, right? We need to maximize our winning streaks. That way we can absorb the drawdown and then make it to that next winning streak. If all of a sudden we are sabotaging our winning streaks, but taking full losing streaks, we're in trouble. I mentioned I'm not a 70% trader. There was a time in my life where I was a 70% trader. There was a time in my trading career where I was a 70% trader. I also wasn't profitable. That's a little shocking, right? I range between 45 and 55% now, and I'm very profitable. I was 70% at one time and I wasn't profitable. Can any of you guys guess what the issue was? Jeff says risk reward. I've got a shocked, scary face. Yeah, me too. Cutting winners short, big losses, small winners, lots of losses. Yeah. So I was a 70% trader, but I had a problem. Young Akil had a problem. And young Akil's problem is that he liked to take the profits a little bit early, right? And at the time, young Akil thought this was helping him. It wasn't really helping him. So I would be in a trade. I was so concerned with win percentage. That was like the thing, right? I got to have a good win percentage, right? Because if you have a good, you can't go broke taking profits, right? That's a bunch of baloney, by the way. And I'm proof. But I would cut my profits short, mainly because I was scared. I wanted to have a high win percentage. And I was trading under the mindset of you can't go broke taking profits, which you can. And I got an even worse story to tell you about that later. So I had this cool win percentage, but I wasn't really making anything off of my wins. But guess what so I'm taking partial wins. Do you think young Akil was taking partial losses as well? No. I took my losses in full, baby. I took all the losses, fill it up, fill it up to the top. Spilled over sometimes, a little moving the stop back, right? I took all the losses. So I would have like these 2-month stretches of hitting at 70%. And then I would blow it all the next month and be back to break even. And in my mind at the time, I'm like, well, I just got to eliminate these losing streaks. But no, that wasn't it. When I went back and reevaluated, the losing streaks were fine. They were normal. They were natural drawdowns. I wasn't making any mistakes. There was a little bit of stop movement, but not too much. I was getting better at that. But I wasn't making any mistakes. These were all natural drawdowns. And I couldn't figure it out. I'm like, why do I keep going back to break even? How come I can't bust out this hamster wheel? The losses were fine. They were normal. The problem is I didn't take what I was supposed to take off of my wins. And therefore, instead of those losses maybe being a little dip, a dip back to the 382 for you guys that know Fibonacci's, these losses took away everything I earned. And I repeated this cycle of like 2 months of awesome trading, and then 1 month would like bring me back down to break even. And it was pathetic. So a few other position sizing strategies, fixed fractional, smooth ratio. I'll show you the smooth ratio later. Fixed fractional is another one. Don't want to get into too much details with it because we don't really teach it. But fixed fractional is basically a way of increasing your position size as your account increases. So like, for example, if you're starting with a $10,000 account, you would say, and you're trading 2 mini lots, right? You would say, once I reach $15,000, like every time I gain $5,000, I'm going to increase my position size. Now, the problem with fixed fractional is this. One, if you're trading with a $10,000 account and you can't increase your position size until you get $5,000, what percentage return is that? Who's got good math? 50%. So be realistic. How long do you think it takes you to get a 50% return? Are you going to do that in a month? A week? No, not at all. A while. Yeah. It'll probably, as a newer trader, it'll probably take you, if you're great, a year. It'll probably take you like 1.5 years, 2 years. So it takes a very long time to get to that first level to actually increase your position size, which isn't a bad thing, but just putting it out there. But then once you get rolling and you're sticking with that $5,000, right? Where initially $5,000 off of a $10,000 account is a 50% return, which is very large. But then all of a sudden to go from 15,000 to 20,000, that's a less of a percentage return. To go from 20,000 to 25, to go from 25 to 30, right? It gets closer and closer. And then all of a sudden you're increasing your position size drastically. And you go from trading a 2 mini lot to a 4 mini lot to a 12 mini lot. And now all of a sudden you're risking too much, too quickly, right? So there are some issues with that. And that's why smooth ratio was created to kind of smooth that out. And again, we'll go into that a little bit later. Hope you found that informative. This was actually a clip from one of our free 4-day online trading workshops. If you were there, thank you so much for making it a great experience. If you missed it, shame on you, but the good news is we do these workshops usually 2 or 3 times a year. So make sure you stay in the mix with what we're doing here at the Trading Coach Podcast, the YouTube channel, anywhere on social. That way you are informed the next time we have one coming out. Until next time, plan your trade, trade your plan, and I'll see you guys next episode.